People always ask me about timing the market. They want to know when to buy, when to sell, when to hold cash. But they're asking the wrong question. The real question isn't about timing. It's about understanding fear and greed. And I can tell you, after 80 plus years of investing, after building Berkshire Hathaway from a failing textile mill into one of the largest companies in the world, the secret to wealth in the stock market is extraordinarily simple. Be greedy when others are fearful, and be fearful when others are greedy. Today, I'm going to teach you exactly when and how to become greedy in the stock market, and why this one principle has made me and my investors hundreds of billions of dollars. Let me start by telling you about human nature, because understanding human nature is more important than understanding finance. Most people have it exactly backwards. When stocks are soaring, when everyone is making money, when your neighbor who knows nothing about investing is bragging about his returns, that's when average investors get excited. That's when they want to pour money into the market. They see prices going up and they think it's a great time to buy. But think about that logic for a moment. In what other area of life do people get excited when prices go up? If you go to the department store and everything is marked up 50%, do you get excited and buy more? Of course not. You wait for a sale. If houses in your neighborhood double in price, do you think that's a great time to buy real estate? No, you think it's expensive. But somehow when it comes to stocks, people abandon all logic. They buy when prices are high and they feel good about it. Then when the market crashes, when stocks go on sale, when everything is marked down 30, 40, 50%, what do? They panic. They sell. They run away. They do exactly the opposite of what makes sense. This is why the average investor underperforms the market so dramatically. It's not because they're stupid. It's because they're human. They let their emotions dictate their decisions. Fear and greed control them instead of them controlling fear and greed. My entire investment philosophy can be summarized very simply: do the opposite of what your emotions tell you to do. When you feel afraid, that's probably the time to buy. When you feel euphoric and confident, that's probably the time to be cautious. Now, let me explain exactly when you should become greedy. There are specific signals, specific situations where the odds are overwhelmingly in your favor if you have the courage to act. First, become greedy during market crashes. I'm not talking about a 5% pullback or a 10% correction. I'm talking about real crashes, when the market drops 20, 30, 40% or more, when panic is in the air, when people are talking about the end of capitalism, when your friends and family think you're crazy for even thinking about buying stocks. Let me give you some examples from my own life. In 2008 and 2009, during the financial crisis, the market was in free fall. Banks were collapsing. The entire financial system looked like it might implode. People were terrified. They were selling everything. Some of the best companies in America were trading at prices I hadn't seen in decades. Goldman Sachs, General Electric, these were world-class businesses being offered at fire sale prices because fear had taken over. What did I do? I became greedy. I wrote an op-ed in the New York Times telling people to buy American stocks. I put billions of dollars to work. And you know what? People thought I was insane. They said, "Warren, the world is ending. How can you be buying now?" But I knew something they didn't. I knew that fear creates opportunity. I knew that when everyone is panicking, that's when the best deals appear. And I was right. Those investments made Berkshire Hathaway and our shareholders enormous amounts of money. The same thing happened in March of 2020 when COVID hit. The market dropped over 30% in a matter of weeks. People were terrified. They had no idea what was going to happen with the pandemic. They were selling stocks indiscriminately. Quality companies were being marked down dramatically. And once again, that was a time to be greedy. If you had bought an index fund in March of 2020, you would have doubled your money in less than 2 years. So the first rule is simple. When there's blood in the streets, when people are panicking, when the news is all terrible, that's when you should be thinking about buying. Not because you enjoy other people's pain, but because that's when assets are mispriced. That's when you can buy dollars for 50 cents. But here's what's critical. You can only be greedy during crashes if you've been fearful during booms. This is the part most people miss. You need to have cash available when opportunities arise. If you're fully invested when the market crashes, you can't take advantage of the bargains. You're just sitting there watching your portfolio go down. But if you've been cautious, if you've been building cash while everyone else was euphoric, then you have ammunition when the time comes. This brings me to the second signal for when to become greedy. Look for industries or sectors that are temporarily out of favor. Markets are not efficient in the short run. They're driven by emotion and narrative. Sometimes an entire industry gets sold off because of temporary problems or negative sentiment, even though the underlying businesses are sound. This creates extraordinary opportunities for patient investors. Let me give you an example. After 9/11, airline stocks collapsed. People were afraid to fly. The industry looked like it might not recover. Most investors wanted nothing to do with airlines. But some of those airlines had valuable assets, strong management, and would eventually return to profitability once the fear subsided. Similar situations have happened with banks after financial crises, with oil companies when energy prices crash, with technology stocks during the dot-com bust. The key is to distinguish between temporary problems and permanent impairment. If a great business is being sold off because of short-term fear or temporary challenges, but the long-term fundamentals remain intact, that's when you should become greedy. You're not gambling. You're taking advantage of other people's fear and short-term thinking. Here's another signal. Become greedy when valuations are compelling relative to historical norms. I'm talking about price to earnings ratios, price to book value, dividend yields, all the fundamental metrics that tell you whether stocks are cheap or expensive when the overall market is trading at valuations well below historical averages. That's a signal that it might be time to deploy capital. Now, I'm not a market timer. I don't try to predict exactly when the bottom will occur. I don't have a crystal ball. But when valuations get to extremes, when stocks are clearly cheap by any reasonable measure, I start to get interested. In 1974, stocks were incredibly cheap. The Dow was trading around 800. People were depressed about the economy, about inflation, about Watergate. Nobody wanted to own stocks. But if you looked at the valuations, if you looked at what you were paying for earnings and assets, it was obvious that stocks were a gift. And over the next 25 years, the market went up something like 20 times. The same thing happened in the early 80s. Interest rates were sky high. The economy was in recession. People were convinced that inflation would never be tamed. But valuations were attractive. And if you bought stocks then and held them through the next 2 decades, you made extraordinary returns. The point is, when valuations are compelling and sentiment is negative, that's when you should be thinking about becoming greedy. Now let me tell you about what I call compounding opportunities. These are situations where you can buy stakes in wonderful businesses run by exceptional management teams at reasonable prices. These aren't necessarily during crashes. These are ongoing opportunities that exist if you're paying attention. When I find a business with a strong competitive advantage, a moat that protects it from competition, run by honest and capable managers who are thinking about the long term, and I can buy it at a fair price, I become very greedy. I want to own as much of that business as I can because I know that over time, that business will compound in value. It will grow earnings, reinvest intelligently, and create wealth for shareholders. This is how I built Berkshire Hathaway, by finding businesses like See's Candies, Nebraska, Furniture Mart, Geico, and later Apple, and either buying them entirely or accumulating large positions and holding them forever. The beauty of this approach is that you don't need market crashes to make money. You just need to find good businesses at fair prices and let compounding work its magic. Most people don't have the patience for this. They want to get rich quick. They want to trade in and out, trying to time every move. But the real wealth is made by finding quality and sticking with it. Let me tell you something that might surprise you. I'm not actually greedy very often. Most of the time, I'm just sitting and waiting. I'm reading annual reports. I'm thinking about businesses. I'm watching the market, but I'm not doing much because opportunities don't come along every day. And when you're waiting for fat pitches, you need patience. Baseball has a rule that if you don't swing at 3 strikes, you're out. Investing doesn't have that rule. You can watch pitch after pitch after pitch And you don't have to swing until you see exactly what you want. Most investors don't understand this. They feel like they have to be active, they have to be doing something. But the best investors I know spend most of their time doing nothing. They're waiting for those rare moments when the odds are overwhelmingly in their favor. This is why I say be fearful when others are greedy. When everyone else is excited, when they're all swinging at every pitch, when valuations are stretched and people are paying crazy prices for mediocre businesses, that's when I become very cautious. I start holding more cash. I become selective. I wait because I know that sooner or later fear will return. The market will give me another opportunity. And when it does, I want to have capital ready to deploy. Let me talk about a specific example of how this works in practice. In 2016, I started buying Apple stock. Now, a lot of people were surprised because I had historically avoided technology stocks. They thought Warren Buffett doesn't understand technology. But I understood Apple's business very well. They had built an ecosystem that created tremendous customer loyalty. They had pricing power. They generated enormous amounts of cash. And at the time I started buying, the stock was trading at a reasonable valuation. So I became greedy. We kept buying. Eventually, Berkshire Hathaway accumulated a position worth over $100 billion. And that investment has been one of the best we've ever made. Not because I timed the market perfectly, but because I recognized a great business at a fair price and I had the conviction to make it a large position. That's intelligent greed. That's using size when you have an edge. Now let me address something important. When I say become greedy, I don't mean reckless. I don't mean leverage yourself to the hilt. I don't mean put all your money into one stock because you have a hunch. Intelligent greed is different from gambling. Intelligent greed means deploying capital aggressively when the odds are in your favor, but always within a framework of risk management. I never invest money that I might need in the short term. I never use margin or leverage for stock purchases. I never bet the farm on a single outcome. I might make large concentrated bets when I have high conviction, but I'm always thinking about downside protection. I'm always asking myself, what if I'm wrong? How much can I lose? This is crucial. You can be greedy and still be prudent. Here's another aspect of timing your greed. Pay attention to human psychology and market cycles. Markets move in cycles. Periods of optimism followed by periods of pessimism. Booms followed by busts. These cycles are driven by human nature, which doesn't change. Understanding where we are in the cycle can help you decide when to be aggressive and when to be cautious. When you hear people say, this time is different, when they're justifying extreme valuations with new paradigm thinking, when retail investors who have no experience are speculating wildly, when companies with no profits are going public at billion-dollar valuations, those are signs we're probably near a top. That's when you should be fearful, not greedy. You should be raising cash, being selective, and waiting for better opportunities. Conversely, when people are depressed, when they're saying the market will never recover, when respected companies are trading at bargain prices, when pessimism is universal, that's when you should be deploying capital aggressively. The cycle always turns, it always has, and it always will, but most people can't see it because they're caught up in the emotion of the moment. Let me share something about international opportunities. Sometimes the best opportunities aren't in the United States. Sometimes entire countries or regions become incredibly cheap because of temporary problems or negative sentiment. If you're willing to look globally, if you're willing to invest where others are afraid, you can find extraordinary opportunities. I remember in the late 1980s and early 90s, Japanese stocks had crashed after their bubble burst. The entire market was depressed for years. Or in the early 2000s, Chinese stocks were very cheap. More recently, during currency crises in countries like Turkey or Argentina, well-managed businesses in those countries have been available at fractions of their intrinsic value. The investors who have the courage to be greedy in these situations, who can look past the scary headlines and focus on fundamental value, those investors have made fortunes. But again, this requires doing your homework. You need to understand the businesses, the currency risks, the political environment. You can't just blindly buy because something is cheap. Cheap for a reason is different from temporarily cheap. You need to distinguish between value traps and genuine opportunities. Now, let me talk about something really important. The role of cash in enabling greed. Cash is not trash, despite what people say during inflationary periods. Cash is optionality. Cash is ammunition. Cash allows you to be greedy when opportunities arise. I've always kept significant cash at Berkshire Hathaway. People criticize me for this. They say, Warren, you're earning nothing on that cash. You should be fully invested. But they don't understand the strategic value of dry powder. When the market crashes, when everyone else is forced to sell because they're over-leveraged or they need liquidity, I can buy. When a great company becomes available at a reasonable price, I can write a check immediately. I don't have to sell something else. I don't have to pass on the opportunity. Having cash gives you freedom and flexibility. It allows you to be opportunistic. This is one of the biggest mistakes I see investors make. They're always fully invested. They're always searching for the next thing to buy. They can't sit still with cash. But if you're always fully invested, you're saying that the best opportunity available to you right now is better than anything that might come along in the future. And that's rarely true. Usually, the best opportunities come along when you least expect them, when markets are dislocated, when fear is high, and if you don't have cash available, you miss them. So build cash during good times. Don't feel pressure to be fully invested just because the market is going up. Wait for your pitch. Wait for that moment when fear has created genuine opportunity. Then become greedy. Deploy your capital aggressively. This is how you generate superior long-term returns. Let me tell you about the importance of having an investment checklist. When potential opportunities arise, when it seems like it might be time to become greedy, you need a systematic way to evaluate whether you're really seeing value or falling into a trap. Over the years, I've developed a mental checklist of questions I ask before making any significant investment. Can I understand this business? Do I know how it makes money? Do I understand its competitive position? Can I predict with reasonable certainty what this business will look like in 10 years? If I can't answer these questions affirmatively, I don't invest, no matter how cheap it looks. I stay within my circle of competence. Does this business have durable competitive advantages? Is there a moat protecting it from competition? Do they have a strong brand, proprietary technology, network effects, cost advantages, regulatory barriers, something that prevents competitors from taking their profits? If there's no moat, the business won't compound value over time, and I'm not interested. Is management honest and capable? Do they treat shareholders as partners? Do they allocate capital intelligently? Do they communicate openly about both successes and failures? I want to invest with managers who think like owners, who are focused on long-term value creation rather than short-term earnings manipulation. The quality of management is often more important than the quality of the business. Is the price reasonable relative to intrinsic value? Even a great business is a bad investment if you pay too much. I need a margin of safety. I want to buy dollars for 50 or 60 or 70 cents, not for $1.10 just because everyone else is excited about the business. Price is what you pay. Value is what you get. They're not always the same thing. If an opportunity passes all these tests, then I start to get greedy. Then I think about sizing the position appropriately. Then I'm willing to act decisively. But if it fails any of these tests, I pass. No matter how cheap it looks, no matter what everyone else is doing, I pass. Discipline is essential. Now let me address a question people often ask me. What about index funds? Should you try to time your purchases of index funds? My answer is generally no. For most people, the best approach is to regularly invest in low-cost index funds regardless of market conditions. Don't try to time the market. Just keep buying through up markets and down markets. But there are exceptions. If you're sitting on a large amount of cash that you want to deploy, if you're thinking about making a significant investment, then yes, it makes sense to wait for periods of fear and pessimism. If the market is at all-time highs and valuations are stretched, maybe hold that cash a bit longer, maybe wait for a correction. But don't try to perfectly time the bottom, you'll never catch it. Just wait until sentiment is negative and valuations have improved, then deploy the capital. The key is not to be too clever. Don't try to trade in and out of index funds based on your market forecast. you'll just pay taxes and fees and probably get the timing wrong. But if you have capital to deploy and the choices between buying at record highs or waiting for a better opportunity, waiting often makes sense. Let me tell you about the biggest mistake greedy investors make. They become greedy at the wrong time. They see prices going up and they want to jump in. They chase performance. They buy what's hot. They invest in whatever their friends are making money in. This is greed driven by envy and fear of missing out, not greed based on value and opportunity. True greed, intelligent greed, is contrarian. It means buying what everyone else is selling. It means being interested in sectors and stocks that are out of favor. It means getting excited when prices go down, not when they go up. Most people have this backwards. They call themselves greedy, but they're actually just following the herd. And the herd is usually wrong at important turning points. So when should you become greedy? When fear is high, when prices are low, when valuations are attractive, when quality businesses are available at reasonable prices, when everyone else is running for the exits. That's when you strike. That's when you deploy capital. That's when you think big and act decisively. But this requires emotional control. You have to master your own psychology. You have to train yourself to feel comfortable when everyone else is afraid. You have to develop conviction based on analysis, not emotion. This is not easy. It goes against every instinct you have. Your brain is wired to seek safety in numbers, to follow the crowd, to avoid risk when others are afraid. But if you can overcome these instincts, if you can think independently, if you can maintain your composure when others are panicking, you'll make extraordinary returns over time. This is not a guarantee of quick riches. This is not a get-rich-quick scheme. This is a proven, disciplined approach to building wealth over decades. I'll share one final insight with you. The best time to become greedy is when you've done your homework in advance. You can't wait until the crisis hits to start studying businesses and analyzing opportunities. You need to have a watch list of companies you'd like to own at the right price. You need to know what those companies are worth. You need to have done the analysis before fear strikes. Then, when the market does crash, when panic sets in, you're ready. You know exactly what to buy. You don't have to scramble to do research while everyone else is panicking. You just execute.
You buy what's on your list that has now become attractively priced. This preparation is what separates successful investors from those who miss opportunities. So start building your knowledge now.
Read annual reports, study businesses you admire, understand what makes them valuable, calculate what they're worth, make your watch list, and then wait. Wait for fear to create opportunity. Wait for greed to subside and caution to return. And when that moment comes, when the headlines are terrible and everyone is afraid, become greedy. Deploy your capital, buy quality businesses at attractive prices, and then be patient. Let time and compounding work their magic. This is not complicated, but it's not easy either. It requires discipline, patience, emotional control, and independent thinking. Most people can't do it. They'll always buy when they should sell and sell when they should buy. But if you can master this simple principle, if you can truly be greedy when others are fearful and fearful when others are greedy, you'll build wealth beyond what most people think is possible. That's the secret. That's what I've done for 80 plus years, and it still works today.